In this video, I'm going to go over the Giberson Glass Studio case and highlight some of the most important aspects of the case. Hopefully, you've already looked at the outcomes, either the video or attended the class session. So this would be the follow-up video to that lesson. Alright, so what we've got here is a company that's a sole proprietor, and it's a small business. And what he does is he's a glass blower, and he makes 4 different product lines right now. And the problem he's having is he's not able to make enough money to give himself a decent income out of it. And things are pretty bad. So I want to go through the case, and I'll point out some of the financial aspects that you have to consider, and some of the product line qualities that you have to kind of wrap your mind around. And then we'll conclude this video. I'll do another video on the Excel portion of the case. Alright, so all these cases are real companies. Some of the names have been changed, but this one's kind of situated in the MBA program at Darden Graduate School of Business. And this is a first-year MBA student who's serving as a consultant for this company, which is actually true for all of them. These were all cases that were written based on real company scenarios. So she's trying to help this person out and realizes that they don't have a whole lot of financial information readily available. And this is very common with small companies. Oftentimes it's exactly like this. You get a checkbook, you got some bank statements, and you got a box full of receipts. It's really pretty bad, but it's very common. And it's oftentimes, you know, people who run these businesses, they don't have enough accounting and finance background. And even times students will say to me, you know, I'll just hire somebody to do that work for me, which I think is a really huge risk for running a business, and will limit the amount of success that you have if you don't have financial wherewithal. So she's there to help him out, and it talks us through that he's been through a divorce, and his wife used to handle all this stuff, and that he needed a minimum of $25,000 a year wages and benefits. I recognize that seems pretty low given today's standards. But the case is probably, you know, quite old. It could be 20, 30 years old. But it doesn't matter. The lessons in the case are classic. And the case is still extremely relevant. So keep that in mind. $25,000 salary is what he would like. And that would include his wages and benefits. Okay, so his production process, he makes 4 products. He has glass tumblers, paperweights, patterned glasses, and vases. And he works in Charlottesville, I think that's in Virginia, in a downtown location. And he hand blows items from molten glass at the end of a long pipe. I don't know if you've ever seen anybody do that. It's really quite artistic. So it talks you through the process here. I'm not going to read that to you, but be sure to look at that because it gives you a sense for what he does. And then this is really important here. He starts with 200-pound batch of glass every week. And later on when we get into the case, you'll see that he does glass blowing for about 40 weeks of the year. Then during the summertime, he goes to trade shows and tries to sell a lot of his products at these craft fairs and trade shows for high-end items. So he has about 40 weeks of the year that he does this work, this glass blowing work. So he starts the week with a 200-pound batch of glass. Each batch contains about 80% new raw materials and no more than 20% cutlet, which was clear scrap glass from the previous week. So he's got this kind of batch system that he uses for creating the materials, and he's really reluctant to reduce the quantity of that batch. I think it's what he's accustomed to working with. And table 1, the next table, shows the recipe that he uses. So he's got all these ingredients here, plus these additional items here, and when you add them all up, it's about $21.43 for a batch, and that's the cost for the week. So it's not terribly expensive. Anyways, even though a lot of that batch, we're going to read through here, a lot of that batch gets thrown out. So he doesn't use a whole lot of it. About 80% of it gets thrown out. There's a little bit that gets recycled, but not really enough. So that's going to be one of the issues that you have to address. Okay, so again, it's $21.43 is the cost per week. It said every batch is for a week. And that's another thing in this case that you kind of have to get your mind wrapped around, is the way that you have to organize the financial information based on his process, as well as the timeline for the various costs. Because some costs are given to you per week, some are given to you per month, and you've got to be able to pull that together in a financial statement. And so the Excel template will help you with that process. Okay, so then, all right, talks more about the production process here. And it says that the total gas used, which is one of his biggest cost items, was a predictable $1,000 a month. And so that's based on this cullet size that he has. So it's really not the cost of materials that's expensive, it's the cost of the gas to run the furnace that's really killing him. So, that might be an area where you suggest he makes some improvements. If he's losing money and he's not able to turn a profit, maybe he needs to turn to some other way. Maybe it's pellets or some other method for firing up the furnace. It would require some investment, though, and he needs some help right away. Anyways, it talks here about the temperature he's got to get it up to, and more about his process every week and how many minutes it takes to do various tasks. It talks more about his process here, and it's telling you in Table 2 for the various product lines, remember there's 4 product lines that he makes, how much pounds each piece weighs. So this is the amount of material. We're going to use this when we try to figure out the cost of the materials, and also apply the cost of the gas. Okay, and here's where it's talking about the waste that he has in this. Okay, at the end of the week, unused glass became cullet or was scrapped. On average, about 50 pounds of unused glass was dirty scrap and could not be recycled. Disposal costs were insignificant. All right, so okay, so here's talking about that he talks with customers and visitors who drop by to watch him work, and he spends time on Sundays and Mondays doing miscellaneous chores and catching up on grinding, sanding, and polishing. So he works quite a bit, right? He works doing all of this blowing work to create the product lines, and he also has to do, hopefully, some bookkeeping to keep track of his finances. And he also has relationships that he needs to develop with his customers, and hopefully can sell them products right out of the storefront. All right, I'll let you read through the finishing and shipping. Again, there's a lot of process that's discussed in the case, and it's all important. Like right here, it's talking about hot time and cold time. Hot time refers to the time that it takes for blowing the glass, and cold time is for finishing, polishing, sanding, and other things that they do to the various products to get them ready to be sold. There are some firsts and seconds, but fortunately for us in the case, the prices are the same, although in reality they probably were different. To keep things somewhat simple for us, we're going to assume they're the same. Production time. So by closely watching the business over a 6-week period, Felicia estimated that Giberson spent the time shown in Table 3 for each type of object blown. So she actually did what we might refer to as a time and motion study to see for each product line how many minutes it took in hot time on average, how many minutes it took in cold time on average. And this is the number of firsts that he would create every week, and this is the number of seconds that he would create every week. It says here, Giberson did all the blowing and finishing by himself, although he mentioned to Felicia that he was considering hiring additional part-time labor to do some or all of the finishing. So the finishing would be this cold time here. And I'll come back and talk to you some more about that when we get towards the end. All right, he's already working a rigorous schedule from September to June. And then, as I said before, during the summer, he spends about 10 weeks traveling to trade shows, and he takes a short 2-week vacation. So here's telling you the sales of his units, the prices per unit. So again, the 4 product lines, the price per unit. This is his price list. It said that sales were slightly seasonable, and Giberson almost always had at least a 2-week backlog. So there's certainly demand for the products that he makes. We don't have information on that backlog, which it would be really nice to know which product lines are the most popular. We've got some information on the number of units that are sold, and you can see that wrapped tumblers are one of the most popular products every week. Okay, the operating cost is one of the first things you're going to look at when you get to the Excel file, because they are listed in Exhibit 1, and I want to get that done and out of the way. Let's take a quick peek at that exhibit. So here's Exhibit 1. These are stated on a monthly basis. So this is what I was saying. Some of the costs that you're given are explained as weekly amounts, and other costs are given as monthly amounts. And so it's telling you office supplies, hand tools, manufacturing supplies, part-time labor. There are these first 3. And then you got a series of other types of operating costs. And I want to bring your attention to one part of the case that helps you sort out what kind of costs those are. It says here, with the exception of expenditures for office supplies, hand tools, manufacturing supplies, and part-time labor, operating costs were incurred every month regardless of whether production occurred. That sounds like a definition of fixed costs, right? So it's saying, with the exception of office supplies, hand tools, manufacturing supplies, and part-time labor. So let's go back. So these first 3 are not fixed, essentially is what that's saying. So it's saying that all the rest of these don't change during the month, right? So they're not dependent on the production. So you're going to have to do that in one of the first tabs of the assignment in the Excel, is figure out which of these costs are variable and which of these costs are fixed. So that's where you fish that out of the case, right there. Okay. Assets and liabilities. So Felicia produced a rough balance sheet for the business as of its inception on September 1, 2006. See Exhibit 2. The most crucial facilities, the furnace and the ovens, had a lifespan of only 2 years. The equipment and gas tanks were expected to last 8 years and the truck 5 years. Giberson's truck payments were $205 a month for 36 months beginning in September 2006. So let's take a look. Very little cash. It's got a little bit of inventory. Some insurance that has been prepaid. So what this represents is insurance that he's paid already. So the cash flow has already occurred, and it applies to future periods. Same thing with the rent. So he's prepaid the rent. Furnace and ovens were $5,000. Equipment $3,000, and gas tanks $4,000. Truck $8,500. These are your fixed assets. They're going to be depreciated. We're going to use a straight line method, which, if you remember, is the cost of the asset minus the residual value if you are given any. If not, assume it's 0. Divide by the useful life. Up here you got accounts payable, which is monies that are owed for inventory, so it's probably these things here. A truck loan on this truck, so there's a little bit of equity on that. And then the total of these liabilities, and you've got a small amount of owner's equity. So of course the balance sheet has to balance here. Assets equals liabilities plus equity. So that's kind of your starting point, your jumping off point. And I think that's the last page. Yep. Okay, so I think we got one more paragraph to look at here. So again, if you're looking for the depreciation, number of years are given in the case here. Furnace and ovens, 2 years. Equipment and gas tanks for 8 years, and the trucks 5 years. The truck payment is $205, and you'll see an amortization schedule in Excel that rolls that out. All right, so he says the most critical issue he faced was his rapidly deteriorating financial position. He only had a few $1,000s of personal savings left, and he doubted that either the banks or his former wife would be receptive to providing additional financing. His need for additional resources was, of course, directly related to the lack of profitability of his business. It was clear to him that he needed to make some significant changes the way he did things, but he didn't know what he needed to change or how. He was also troubled that he didn't know what each of his products cost, so he doesn't know what each unit costs him or which items were most profitable. He knew his prices were too low, but he didn't know how to think about a new pricing strategy. On a more positive note, he'd been receiving numerous requests from his existing customers to produce unique handmade order products they had designed. To date, he had not fulfilled any of those requests, primarily because he didn't know how to calculate the cost or how to price them. So this is where that whole general rule comes in with special orders. So, of course, if he can make more on these unique special made-to-order items than he can on his regular products, then he needs to make a choice. He needs to choose on the side of profitability and perhaps either increase his prices on his other units, which might cut down on some of the demand on those. So there might be some sabotage that goes on, but he'd be further ahead in the end to pursue unique work or custom work if the contribution margin on that work is higher than the contribution margin on his existing product lines. So that's something you've got to sort out for him. Okay, so he was interested in expanding his product portfolio. He was quickly running out of time and was open to whatever suggestions Felicia might have. So that's the end of the case in terms of what you're provided in the casebook. And the next step is to open the Excel file and go ahead and start running through the numbers and tackling the various questions that it posed for you to think about. Okay.